So Paul Deemer is here to talk about what is project finance and why it's important. Paul's a retired partner resident with JC Elkins, where he spent his legal career. During his career, he's focused on international mergers and acquisitions and on development and financing of international energy projects. Over the course of his career, he's opened firm's offices in Moscow and Beijing, was based in London prior to time to his partnership. Paul currently works as counsel within Elkins on energy transactions and projects, assisting companies headquartered in one country in the acquisition of energy companies and asset subordinations. Paul is qualified for practice in Texas as well as here. He's a graduate of Vanderbilt University, where he's an adjunct professor. He regularly teaches a short course on project finance at Vanderbilt. He was doing the same as a visiting professor at Deemer in London, and he is in the middle of teaching a course at CUHK. I initially met Paul a couple of years ago at Vanderbilt. It was by this connection we invited Paul to talk about project finance here last year. The session was very popular with the students. We invited Paul back. We're delighted he was accepting our invitation. And we look forward to his intriguing and insightful introduction to project finance.
Brian, thank you very much. And it's a real pleasure to be back at Cambridge, particularly after spending several weeks, months actually, in Hong Kong. I would like to start off by giving you maybe a little bit of a concrete example of what I'm going to talk about. Let's assume that you're a lawyer working for a law firm or a company, and the client comes in and talks to you about a new project. And let's say that it's a large infrastructure project, maybe a power plant or a petrochemical facility, or maybe it's a highway, or even some other infrastructure project. And the client says, you know, we've got this huge project, it's going to cost a lot of money, and it involves a huge amount of risk, but also quite a bit of reward. The facility we're going to build will produce income, which can be used to pay for the financing. But the problem is, what kind of financing should we get? And the client says, I've heard that project financing is a good idea. So over to you, lawyer. Explain, what is project financing? Why is it important? What's good about it? And also, by the same token, what's bad about it or what's difficult about it? So that's sort of what we're going to cover. Now, we have about a half an hour. I'm going to try to cover some slides in half an hour and run through what is a project financing and who's involved and what's it all about. And then we'll have questions. Now, this is kind of a daunting task because in other courses I take 3 or 4 months to go through all this. So please pardon me if I'm covering some of this fairly quickly. By the way, these pictures give you a good example of the types of projects that could be project finance. Now, here are the questions we're going to talk about. What is project financing and how does it differ from other types of corporate financing? What is leverage? Why is it important? What legal structures are used? Who are the participants? And what's the role of the lawyer? Now, I was talking to a friend of mine who's also a project finance lawyer, and I asked him to give me just a one-liner short description of what project finance really means. And he said, you have a developer of a new project. The developer wants to ring fence it, build a wall around it, isolate it legally, and put in asset level financing, as opposed to simply having a corporate financing of the project. But if you're going to do asset level financing, there will be special things you have to think about in putting together the financing. And this slide gives a couple of other similar definitions. It's a method of raising long-term debt financing for major projects. Now, the structure is based on lending against cash flow generated by the project. It depends on a detailed evaluation of the project itself, its construction, operating, and revenue risks, and their allocation between investors, lenders, and other parties. Now, if you're a sponsor, of course, and if you're General Motors, for example, General Motors could go to their bank and say, we want to build this electric power project. We'd like to borrow all the money, and the borrowing will be an obligation of General Motors Corporation. The company will either promise to pay the borrowing, or it will guarantee a subsidiary that actually borrows the money. Now that I would call a corporate financing of a new project. But project finance is quite different. And I'll run through here the key characteristics of a project financing. Already mentioned the sponsor is raising money for a new project like a power plant. Typically a large capital-intensive project, frequently used for energy, infrastructure, or transportation. The lenders agree to look principally to the cash flows from the project for repayment. So instead of having General Motors as the obligor, the lenders are willing to look to a subsidiary company that actually owns, builds, and operates the plant. And that is the security for the loan. Project financing should be non-recourse to the sponsors, to the ultimate owners. And we'll talk about what that means. The sponsor's potential loss is usually limited to their equity stake in the project. And the collateral is usually the project assets. And those project assets are owned by a special purpose project company. Now, not mentioned on this slide, but let me give you an advance warning about it. One of the key characteristics of project financing is leverage. And by leverage, this is the sponsors try to achieve the highest degree of leverage, or the greatest degree of leverage they can. And by that, I mean the sponsors who are putting the project together will attempt to negotiate with the banks for the banks to loan 80% or even 90% of the cost of the project. And only 10 or 20% of the cost will be put in by the owners, the sponsors. Now, so for example, if you have a £1 million project of some sort, £800,000 would be loaned by the banks, $200,000 would be put in by the shareholders of the project company that actually does the work. Now, why is leverage so important? What's so great about leverage if you're a sponsor, if you're developing a new project? This demonstrates the importance of leverage. If you look at the left-hand column, you have a project that costs 1,000 units, zero debt. So there's no leverage at all, no bank loans. Equity, that is the sponsors, the developers, put in 1,000 units. The project earns 100 units per year revenue. There is a return on equity of 10%, that is 100 of 1,000. So the sponsors are getting a return on equity of only 10%. Sorry. Of only 10%. Now, take the right-hand column. You have the same project, 1,000 units cost. You have high leverage, 800 units of debt, and only 200 units of equity being put in by the sponsors. Same revenue of 100 units. Interest on the debt, let's assume 7%. So the interest cost is 56. The profit to the sponsors is 44. The sponsors have increased their return on equity from 10% to 22%. And not only has the return on equity shot up, but also they're only putting 200 units into the project. So they have another 800 to use on other projects. So they can do 5 projects for the same equity investment that they had on the first column. So not only do they have a higher return on equity, but they have less commitment of their own funds. Now, you could say the first building block of a project financing is to negotiate with your lenders for the lenders to provide sufficient amount of funds to give you high leverage. The second aspect of this is recourse. The project is being built by a project company. The project company is owned by the sponsors. They're the shareholders of the company which is actually building the project. Now, the banks, in discussing a project financing, will say, okay, we're willing to lend 80% of the money, but sponsors, we'd like for you to guarantee every borrowing. We want you to guarantee that if there is a default in the loan, you will pay for the project company. Now, in a project financing, the sponsors will normally respond, sorry, this is a project financing. We'll probably be paying a higher rate of interest. We are creating a special purpose company to build the project. That is your security lenders. That's what you're relying on. And we, the sponsors, the shareholders, are not planning to guarantee this debt. If the project is a success, we all win. If the project is a failure, then the banks are taking that risk. Now you say, why would the banks take such risks? Well, the banks frequently will get a higher rate of return, a higher interest rate from the project. The banks may know the developer well, and we'll talk about characteristics of developers in a minute. And the banks want to make the loan and make the project a success and go forward. So in a real project financing, the banks will agree not to look to the sponsors. Now, of course, there are always exceptions to that rule. The ideal is the lender must look to the revenue generated by the project and would have no recourse to the sponsor.
Yep.
But frequently you will find in a project financing that the sponsors are willing to give some degree of support to the project company which is building the project. And there are various types of sponsor support. We won't go into detail about all of them, but you can think of them conceptually. The sponsors are agreeing to give a limited guarantee of their project company which is building the project. That limited guarantee may be nothing more than sponsors agreeing not to sell their shares of the project company. Or it may be something more substantial, that sponsors are agreeing that if the project is not built, if the project is not completed, the sponsors are responsible for the loan. But when the project is completed, at that point, the loan becomes completely non-recourse. The sponsors are no longer liable on their guarantees. And that we refer to as a project completion guarantee. The sponsors agree that the project will be completed on time, as planned, to specification and to budget. So it's a limited guarantee that goes away when the project is built. Now, what are the advantages of project financing? I've already mentioned the big advantage, which is leverage. The second point here, recourse to an identifiable pool of assets, but non-recourse to the sponsors. Normally longer loan tenors, there may be 15, 20-year loans. Suitable where there are more than one sponsor. It might be off balance sheet for the sponsors, but normally not. Normally there would be balance sheet reference for the sponsors. And it provides independent third-party confirmation of the project's viability. And what I mean there is when the lenders take a look at your project and try to decide whether they're willing to make a project finance loan, they examine the project in great detail. They conduct due diligence on the entire project. And if the lenders finish the due diligence process and decide that this project is good, we're willing to finance it 80%, that confirms what the sponsors already believe, that the project really is a valid project. So it does give a certain degree of comfort to the sponsors that third-party lenders would be willing to support it. Now, what are the bad things about project financing? Higher transaction costs. It involves a lot of lawyers. Lawyers for the sponsors, lawyers for the banks who are making the loan, lawyers for the counterparties who are involved in the project, such as the construction contractor that will build the project. A longer transaction process. It takes forever. I can think of one, a power project in the UK that went on for more than a year through the financing phase. Actually, the project was being developed for several years before they got to a financing stage. Increased loan monitoring. The sponsors have to give away some of their control over the project. The lenders are more involved because they're bearing 80% of the risk. In fact, they're bearing even more than that because they're not getting a parent guarantee. Complex documentation, extensive due diligence. Now, I mentioned that point about confirmation. Actually, the sponsors will conduct their own due diligence at the beginning of the project, and they will do a feasibility study, and they'll do market studies, and they'll do technical studies to try to determine whether they want to go forward with the project. Then, when they get to the financing stage, when the project is ready to go forward, subject to financing, the banks come in and conduct almost exactly the same types of due diligence, looking at the feasibility market, the need of the marketing of product of the project, and the conducting a legal due diligence project. And so, and that second due diligence is going to be extensive. And it costs a lot of money, and that money, unfortunately, will have to be paid by the sponsors, normally. This just quickly details the types of projects that project finance facilitates. frequently used on natural resources projects such as pipelines, petrochemical projects, LNG facilities. It can be used for new and improved infrastructure, particularly in developing markets, where the government of the developing market, the government of the developing country doesn't have the financial resources to build a new port and LNG facility. And so they turn it over to private sector development. And the private sector will be willing to go forward, but in many cases, project finance is key to the project sector taking it. It gives the developing country access to private sector efficiency, competition, innovation, and the sponsors get a significant return on equity from leverage. Is the project suitable for project finance? The developer, the sponsors, will be asking that question from the very beginning, and the lenders will certainly be asking the same questions. Is there a strong economic rationale? For example, if you're building a power plant, is there a market for the electric power that's being produced? And can you get a tariff, a price for your electric power that is sufficient? Is the technology that's proposed, is it proven? Or is it new technology that may have a higher degree of risk? What about the equator principles? The equator principle is something you probably run into already, but it's a risk management framework used by lenders, and particularly the project finance area. And it's a set of principles that allow banks and financial institutions to evaluate whether the environmental and social risk involved in a project. So if you have an oil and gas development in the Amazon basin of Ecuador, which will displace local communities, probably there will be a complete disconnect with the equator principles, and the banks, for that reason, may not be willing to lend the money, which means the project cannot go forward. So keeping an eye on the equator principles is important, not only to the banks, but also to the sponsors. A contractual regime that's robust, the banks will look at the contracts for the project and will try to determine whether those contracts are strong, well-negotiated, clear enough. Long-term supply and offtake contracts. If you're building a power plant, you need fuel for the power plant, and that fuel, for example, natural gas, may be supplied in a long-term contract, and that contract is extremely important. The sale of the electricity, the offtake, and those sale contracts for electricity come in many different forms, but the offtake arrangements will need to be robust. Or if the power plant is selling into an established market, that market will have to be scrutinized. Clear and stable legal regime. If you're building the project in Cambodia, it's worth taking a look as to the stability of the, I'm going to Sri Lanka in a few days. The new Sri Lankan government is re-examining many of the projects that were awarded under the old regime in Sri Lanka. And so it's not only a political risk issue, but it's also certainly an issue that would be examined by capable sponsors. Government support. Is the government supporting the project and in favor of it? I mean, some years ago, some developers built a huge power project in India called the Dabal Project, which was supported by the Congress Party. But there were elections, the BJP party took over the reins of government, and BJP opposed the project. That's sort of a change in the political landscape that can cause huge problems for the sponsor. Now, this is just a quick run through. We've already touched on much of this. Who's involved in the development of a project? Of course, sponsors, who are the developers, promoters of the project. They form a project company which will own and operate and borrow money for the financing. There will probably be an off-taker. In the case of a power project, that off-taker may be a purchaser of electric power. There will be a construction contractor, often referred to as an EPC contractor, meaning engineering, procurement, and construction contractor who works on the basis of a very tightly drawn construction contract for the project. The host government will be important, not only to give support to the project, but just to provide consents for construction, for operation. There may be a fuel supplier, and there probably will be an operator of the project, and there will be lawyers, financial consultants, and technical advisors, environmental consultants, and insurance professionals. Now, the financing of the project, again, you have a project company, which is the borrower. You have a group of lenders. You have export credit agencies who may be involved. You may have multilaterals such as EBRD or bilaterals and advisors. Now, I'll skip this one. This is sort of a quick summary of the paperwork that is normally involved in a financing transaction for project financing. Again, the due diligence process is key. And here is a diagram showing some of the things we've talked about. In the center is the project company, which will own, operate, construct, operate the project, whether it's an electric power plant or an LNG facility or a pipeline. It's owned by sponsors who are the shareholders of the project company. The project company enters into contracts with a construction or EPC contractor, possibly a fuel supplier, maybe a power purchaser who off-takes from the project. And then on the right, you have a suite of financing documents for the project financing. And the key financing document being the facility agreement or loan agreement at the very top. So, why should a new lawyer be familiar with project financing? Well, again, taking you back to the beginning of my comments, the day the senior partner in your law firm or your employer, if it's a private company, or if you're in government, perhaps your superior comes in and says, we've got a project financing, you need to be concerned about this and tell me where the problems are. And so lawyers frequently play a major role in project structuring, in due diligence, in risk analysis. And they are concerned with taxation and regulatory advice. Are permits required for the project? Land acquisition for the project, environmental issues. The project contracts have to be negotiated. The financing structure needs to be discussed from both a legal and a financial standpoint. the finance and the security documents need to be negotiated, and lawyers play a key role on both sides for the lenders and for the borrower of the project company. And there may be disputes, and there may be problems. For example, the project may run into financial difficulty. There may not be enough of a market for the widgets that are manufactured by the project, and the project company may not be able to pay the loan. So at some point, the lenders may have to sit down with the project company and its lawyers and try to work out a resolution, a restructuring, or maybe a restructuring of the loan arrangements. And, or this may fall into the dispute category. So on all of these things, all of these are legally intensive. So if any of you have a serious interest in project financing, I would say go for it. It's a terrific area to be in, and it'll continue to be important as long as large infrastructure projects are being built. So I think we're a little bit over, Brian, but maybe we can have a few
That's all good.
questions.